Investors should consider investing into the bond market as well to diversify their investment portfolio away from only equities to balance risk involved in both low and high volatility investment markets for long-term stable returns. Chan Cheh-Shin, investment advisor at HwangDBS, says Asian investors have a tendency or cultural preference to equities instead of bonds, causing the bond market to be shallow and thin.
Your portfolio must be diversified in a way that balance out between a riskier asset class in volatility and a lower volatility asset class. You don't always 100% go into high volatility, high return, 100% all go into fixed deposit. Because as an investment, you have to look right through different kind of cycle, and as your life cycle change, your demand or taste of investment also change. But all in all, you have to balance out.
As why greater emphasis is given to the equity market in the country, Chan says this is because the market is more accessible, as the banking system is flush with liquidity and loans for businesses can be obtained easily. He adds that in the US and European countries, industries and business people need to find other alternatives to raise funds, as banks there are absent of high liquidity and are unwilling to easily lend, leading to a more active bond market.
Asian government has run our country so well, we have all the surplus. When the government had all the surplus, do they need to come out to borrow? Don't need. So government no need to borrow. The bank is flush with liquidity, so the debt market is dead. So in the global sense, but outside Asia, the bond market is very active. Whether you trade the government or you trade the corporate, it's very active. So that, again, there is what we call difference in market development, difference in preference.
Meanwhile, HwangDBS CEO Teng Chi Wai says in Asia, the bond market is largely seen as a game for professionals and institutional managers, while the men on the street are more comfortable with the equity market as it is easily accessible.
Bonds are safer than equity. Is that if you look at the volatility of bond funds, even in Malaysia, if I look at our bond fund, our volatility is only 2%. You look at our equity funds in general, it's all range between 18 to 20%. So you'll find that the bond funds have very low volatility. Of course, the long-term return on bond funds is about 5-6%, compared to equities is probably at about 9-10% or so.
Speaking to reporters after a media briefing on HwangDBS Investment Management Fixed Income Fund, Teng says there are groups of people who are more comfortable with receiving smaller returns and taking less risk, and bonds provide an alternative for them. Chan, who is also Asian Islamic Investment Management Sdn Bhd Aiman's Chief Investment Officer, adds bonds are a safer asset class with low risk similar to fixed deposit. Aiman is jointly owned by DBS Asset Management Limited and HwangDBS Malaysia Berhad. Teng says the strong demand for bonds in the first half of 2009 was a clear signal of investors' appetite for additional yields, saying the fixed income market can potentially be an investor's heaven in current times and for the long term.